Making 3 lakh a month is a great place to be. You have the means to build real wealth. But without a clear plan, it's easy for lifestyle upgrades and scattered investments to eat into your progress. Hello and welcome to our channel 5 Minute Finance by ET Money, where we simplify the basics of investing and personal finance. In this video, we are going to give you a quick tour of how to manage your finances if you are earning 3 lakh per month, from building and maintaining an emergency fund, buying adequate insurance to making investments to fulfill all your goals. So let's start with the basics. 3 lakh per month puts you within the top 5% of earners in India. That's 36 lakh annually. But the fact is that the more you earn, the more your lifestyle expands. You upgrade your car, move to a better apartment, dine out more often, and before you know it, even 3 lakh per month does not feel like enough. That's why your financial foundation needs to be rock solid. So before we discuss investments, let's talk about your financial foundation. So start by building an emergency fund worth 6 months of expenses. If your monthly expenses are around 1 lakh, aim for 6 to 9 lakh in a liquid fund or savings account kept aside only for emergencies. Now, why does this matter? Let's say you start investing, but then suddenly there's an unexpected medical bill. Your car needs an urgent repair or you face a job loss. Now, without a cash buffer, you might have to break your investments, take an expensive loan, or borrow from others. That's why an emergency fund isn't optional, it's an important part of financial security. So, the usual 50-30-20 budgeting rule does not always work well at this income level. A better approach: reverse budgeting. Here's how it works. The moment your salary hits your account, set aside your savings first. Let's say you allocate 60,000 to investments and 40,000 towards building your emergency fund. Next, cover fixed commitments like home or car loan EMIs. Let's assume you have 30 to 50,000 in EMIs. These should be covered first, even before you think about discretionary spending. Now finally, ensure your risk protection in place with health and life insurance. Medical costs have been on a rise, so go for an adequate health insurance cover. Make sure to cover your dependents as well. You may opt for a family floater plan if you are married and have kids. For parents, you may opt for a special senior citizen health insurance plan. For life insurance, you can go for an adequate term plan to provide financial stability to your family in case of an unforeseen event. Now, you can find both health and life insurance solutions on the ET Money app. So do check them out. Now, once you've taken care of your emergency corpus and insurance, you'll roughly have around 1.3 to 1.6 lakh for living costs, travel, shopping, and leisure. Now, before investing, be clear about why you are investing. Your goals will decide your investment choices. So, if you are in your late 20s to early 30s, you might focus on building a house down payment fund, travel goals, or aggressive wealth growth. If you are in your late 30s to 40s, children's higher education, retirement corpus, and debt repayment may become your priority. If you are in your 40s and 50s, capital preservation and retirement income streams take center stage. So once your goals are clear, you can match each one with the right investment product, asset allocation, and time horizon. This ensures every rupee you invest is working towards something specific. On the ET Money app, you can get multiple solutions to optimize your investments and savings goals. So do explore them today. Now let's talk about where that 60,000 per month, which is around 20% of your monthly salary, should be invested. A smart way to structure your portfolio, especially when you want both stability and growth, is the core satellite strategy. Now, the core holdings will be the foundation of your investment portfolio. Its job is to deliver consistent returns with lower risk and broad diversification. Depending on your risk tolerance, the core portfolio could include equity funds for long-term growth. Here you can include large cap or diversified equity funds. Now, as large cap funds invest in India's biggest and established companies with proven business models, they tend to be less volatile than mid and small caps. And diversified funds like Flexi Caps can invest anywhere without any restriction on the market cap as per fund manager's discretion. We also have hybrid funds that mix equity and debt in a single portfolio, giving you exposure to growth while also holding safer debt instruments that can limit losses in market crashes. Now, while the equity part aims at capturing market upside, the debt portion aims to provide stability to generate regular interest income and reduce overall volatility. But you should be aware of the risks in the core portfolio as well. Even large cap and diversified equity funds are not cash proof. Now, for instance, between October 2024 and February 2025, large caps fell about 14%. The market eventually recovered, but such dips can test your patience as funds return can turn negative temporarily. This is where you can be more strategic and try to boost returns. Here you can take on slightly more risk because it's a smaller part of your overall portfolio. Your satellite portfolio could include mid or small cap equity funds for higher growth potential. They also come with higher volatility. International funds to diversify beyond Indian markets. Now, as mentioned earlier, the satellite portfolio carries higher risk, so you need to tread carefully. Mid cap, small caps, and sectoral funds can see worse drawdowns than large caps, and such drops are not rare. If your chosen fund underperforms, losses can be much larger than in the core portfolio. So, what can this core satellite portfolio do? The core gives you stability and market returns. Satellite gives you growth potential. You are diversified across market caps, geographies, and risk levels. Now let's look at some numbers to see how much money can be made at different rate of returns that we have assumed. Suppose your core portfolio grows at 10% CAGR. In next 10 years, you could build around 80 lakh rupees. And if you continue your investments for 5 more years, that can double to 1.6 crores. At a higher 12% rate of return, you're looking at roughly 90 lakh in 10 years and almost 2 crores in 15 years. Similarly, the satellite portfolio earning 10% could give you about 80 lakh in 15 years. If it grows at 12%, that can jump to around 95 lakhs, and at 15%, you are looking at nearly 1.23 crores. Now, before we conclude, you must know that with a 3 lakh rupees salary, you are in a strong position to build wealth if you start now and stay consistent. Avoid traps like over diversification, which causes duplication and extra costs, and lifestyle inflation, where every raise funds upgrades instead of savings. Instead, direct part of each increment straight to investments before spending. And this brings us to the end. If this video helped, do like, share, and drop your questions in the comments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.